If I look backward, as you well know, Tesla accounts for almost a fifth of the return that you have generated in that 5-year time span. Which of your current holdings, Cathie, do you think will supply the biggest lift in the next 5 years?
Tesla's still in the running, but I would have to say the biggest upside surprises are going to come from the genomic space. And that's because the convergence of DNA sequencing, artificial intelligence, and gene therapies, importantly, CRISPR gene editing, are going to cure disease. That convergence is going to cure disease. Now we have real science and technology surfacing the mutations in our genomic profile. And as they surface those mutations, what do we see? We see the earliest manifestations of disease. And now, with the combination of artificial intelligence and gene editing, we're able to both anticipate diseases and cure them potentially. Beta thalassemia, we're seeing it, sickle cell disease. We even think it will work in diabetes, which is where most, if you look at the largest category of spending year to year in healthcare, it's diabetes.
Cathie, another surprise for me in your portfolio attribution is that almost none of your performance, just 20 points out of 600 points, is from Apple, Microsoft, Amazon, and Facebook, the 4 biggest contributors to the S&P 500 over the same period. What about them doesn't make the grade for Cathie Wood and for ARK?
Well, we're not saying they'll be bad stocks at all. In fact, they've been very good stocks. And they were a part of our portfolios in the early days. But as they were scaling into the $1 trillion category, we believed that our research would be focused better on the next set of fangs. And I don't mean fangs meaning in the internet age. We actually think the next fangs are in the genomic age. And if you'll notice our flagship portfolio, the largest exposure is healthcare for that reason.
What would make you reconsider investing in those stocks?
What would encourage us to move back into that ilk of stock is a continuation of what we're seeing now, so that some of our valuations become stretched beyond our minimum hurdle rate of return. So our minimum hurdle rate of return for any stock entering our portfolio is 15% at a compound annual rate over the next 5 years. So that's the doubling over 5 years. We're not there yet, but if we're in the low 20s, which is much more than a doubling over 5 years, but if we started seeing more and more of our stocks lose that return expectation and drop below 15%, we would move back towards some of the FANGs and Microsoft because we would be treating them essentially as cash-like instruments for our strategy. So what we do is, as a bull market extends, we do move into more cash-like equities. They would be the less volatile stocks, and certainly the FANGs and Microsoft fit that. And we would do that